Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, analyst, again here with you this week to cover this week's Market Carver, where we've got three topics for you. We're going to cover last week's Federal Reserve meeting, an important one in terms of a turning point that Zach will cover for us. Talk about global refining capacity, kind of an obscure topic, but something in the way of good news for you on that front. And then we're going to talk about Bed Bath & Beyond. That's a story now that's a couple weeks old, but have some diamonds in the rough there in the way of some things to talk about with regards to it. So, Zach, we'll kick it off to you here, and if you would give us the highlights of the meeting, the outcome, and what Jay Powell had to say.
Yeah, so we did get a 25 basis point hike last week, which was in fixed income and in the equity markets pretty well expected. Interest rate traders had over a 90% chance probability priced in that we were going to get the 25 basis point hike. The turning point sort of came in the statement that was released along with the decision. And there's been a pretty notable phrase that's been included in most of the interest rate hike statements over the past year, saying that they anticipate some additional increases might be appropriate. And if you look at the statement this time, you'll notice that phrase that's been so widely used was removed, and it was changed to say that they will carefully monitor the economy and the effects of their rapid increases over the past year. So it feels like for the past year or so, the Fed has been looking for reasons not to raise interest rates, and there's a little bit of a pivot here where they're going to start to monitor the effects of the rapid interest rate increases over the past year or so, along with some of the banking. The stress in the banking sector, to just sort of see how all of that impacts the economy. They're going to monitor over time and maybe look for a reason. They're going to be needing to be compelled to raise rates again, rather than that being sort of the default. Some of the data that's used to gauge the strength of the economy, particularly in the labor market and in consumer activity, specifically around consumer spending, has actually remained relatively strong. And so if you look at a dot plot, which is essentially just telling where each Fed official expects the interest rates, the Fed funds rate to be at the end of each calendar year. Pretty consolidated in 2023, but then if you look at 24, it is pretty widespread, indicating that there may be some lack of consensus starting to show up in terms of what the next move is, whether we raise a couple more times, we hold pat, or we start to do rate cuts. And I thought that this quote from Chairman Powell was a pretty good summary of where they stand right now. He says, "We on the committee have a view that inflation is going to come down not so quickly. In that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates." So Jay Powell kind of pushing back on the idea that they're going to be rapid interest rate cuts following the pause and hikes, but we may see them just hold where they are for a while, sort of let the effects of the interest rate increases and the banking stress sort of play out, and then move from there. So that's the Fed update, and I'll throw it back over to Adam for refining capacity and Bed Bath & Beyond.
All right, so refining capacity here, we can easily see through a chart, and this is across the globe, that the key word there. If you were to just look at the United States, you would find that in 2016 through, say, the last few years, we have been outright contracting in refining capacity, which was actually the case globally. That means that we were taking down more refineries than we were building, something that we just haven't done in the United States for a long time, and still don't have a lot of plans to do so. But if you look across the world, we are expecting finally to see some investment along those regards. So a lot of the expected growth in energy usage, of course, continues to look like it'll come from China and India and really many different parts of Asia. But we're finally seeing a growth here. The reason that's important is many times we've seen gas prices spike. I think you all are accustomed to that. And especially last year, it was acute at one point where we just don't simply have enough refining capacity to meet the gasoline needs. So it's not always an oil problem. It is simply not having enough capacity to turn those barrels of oil into gasoline. So hopefully that's a supply and demand issue that'll come into better balance in the coming years. And so lastly, we'll leave you with Bed Bath & Beyond, pretty large retailer across the United States. I'm sure most of you have been there. I have. Couldn't forget it. Shopping's not my thing, so it's going to stick out walking through a place like that. But anyways, if you had somebody working there, certainly we don't like to see challenges or people getting laid off. That's a trouble. But I want to focus on it from a real estate perspective. So if you're the landlord here, and there are certainly some that own large blocks or many different of these units that were leased to Bed Bath & Beyond, your first inclination is to be horrified, right? That's a lot of space that is all of a sudden going to go empty. But if you look beyond that surface, actually, there's some good news there. And actually, some of the landowners, and that may not be the case for all of them, but some of them are quite pleased. And it has to do with inflation. Because we have seen inflation move up, that means that the rental rates going for retail space have moved above and beyond what were in these leases to Bed Bath & Beyond. So as they find new tenants, and the fact that we haven't built a lot of retail space, nobody's really wanted to invest and build a brick and mortar store with the rise of e-commerce over the past decade. So what that means is that there's a naturally pretty healthy balance between those that need retail space and the amount that we have. And so this space that's come open, there's a lot of potential for these stores to actually increase the rental rates for these landowners. So it may be horrifying to see a big unit like this go out. They may actually wind up even better, finding better tenants, and those that drive more foot traffic than these stores were doing. And so to me, that's just a story to really look beyond the headlines. That's why we want to look at the fundamentals of investing, whether it's a bond, a stock, or in this case, real estate. So that's all I have for you this week. And Zach and I and the whole team appreciate you giving us a few minutes. Don't forget to give us a call if we can be a help, 800-928-4001. Hope to hear from you soon and have a great weekend.